Navigating regulatory capital requirements in modern banking. In today's financial landscape, navigating regulatory capital requirements is crucial for banks to ensure stability and compliance. Let's delve into what these requirements are and how banks can navigate them effectively. Understanding regulatory capital requirements. Regulatory capital requirements are set by financial regulators to ensure that banks have enough capital to cover potential losses and remain solvent during economic downturns. These requirements are based on international standards such as Basel III, which mandate a minimum level of capital that banks must hold relative to their risk-weighted assets. Core components of regulatory capital. There are two main components of regulatory capital: Tier 1 capital and Tier 2 capital. Tier 1 capital includes common equity and retained earnings, which are the most loss-absorbing forms of capital. Tier 2 capital consists of subordinated debt and other instruments that provide additional loss absorption capacity. Importance of regulatory capital adequacy. Maintaining adequate regulatory capital is essential for banks to protect depositors, investors, and the financial system as a whole. Banks with insufficient capital may face restrictions on activities or even be forced to close down. Therefore, banks must carefully manage their capital levels to meet regulatory requirements. Strategies for navigating regulatory capital requirements. Conduct regular stress tests. Stress testing is a vital tool for assessing a bank's resilience to adverse economic scenarios. By conducting regular stress tests, banks can identify potential capital shortfalls and take proactive measures to address them. Optimize capital allocation. Banks should allocate capital efficiently to support profitable activities while meeting regulatory requirements. This involves weighing the risk-return profile of different business lines and adjusting capital allocations accordingly. Monitor capital ratios. Maintaining healthy capital ratios is key to demonstrating compliance with regulatory requirements. Banks should closely monitor their capital adequacy ratios and take prompt action if capital levels fall below regulatory thresholds. Enhance risk management practices. Effective risk management is essential for maintaining regulatory capital adequacy. Banks should implement robust risk assessment frameworks, conduct regular risk reviews, and adjust their capital planning strategies in response to changing risk profiles. Conclusion. Navigating regulatory capital requirements in modern banking is a complex but essential task for banks to ensure financial stability and regulatory compliance. By understanding the core components of regulatory capital, implementing sound strategies, and enhancing risk management practices, banks can navigate these requirements effectively and safeguard their long-term viability. Want to learn more? Claire Trifle on LinkedIn.